Are you wondering what the economic profit framework is and why it is one of the two frameworks we are using to analyse financial statements? This video will focus on the economic profit framework, one of the two frameworks we will use in our unit. Check out the video 2 frameworks, focus on DCF, to find out more about the other framework we will use in our unit. The economic profit framework focuses on abnormal earnings. The difference between a firm's earnings, comprehensive income, and its cost of capital. This has the benefit of being a direct measure of value add in a business, the extent our firm can add value above its cost of capital. Both the DCF and economic profit frameworks are grounded in the idea that the benefit, and only benefit, equity investors gain from owning shares in a firm are the expected future dividends from those shares. This includes a final dividend, which is the amount paid to equity investors when the firm is liquidated or taken over at the end of its life. We could view the equity value of a firm as the present value of expected future dividends. The only problem with this is that it is extremely difficult to forecast a firm's dividends because it is based on the discretion of a firm's management and board of directors in deciding how much to pay in dividends each year. Another way of putting this is that dividends are not a measure of value add, but are rather a transfer of value between a firm and its equity investors. The economic profit framework looks at abnormal earnings, the difference between a firm's earnings, comprehensive income, and its cost of capital. This is a direct measure of value add. The economic profit framework can be expressed as the value of equity, VE, equals the current book value of equity, BVO, plus the present value of abnormal earnings, AE. If we think a firm cannot add value from its financing activities, then we can focus on abnormal operating income rather than abnormal earnings. And our economic profit framework becomes the value of equity equals the current book value of equity plus the present value of abnormal operating income. Abnormal operating income equals operating income, OI, minus the cost of capital for a firm's operations, weighted average cost of capital, WACC, times net operating assets invested in the business. For further information on the two frameworks we'll be using in our unit, go back to Chapter 1, Section 1.2 in the study guide and review the How a Firm Adds Value weekly questions. Also answer, write and rate questions on how a firm adds value in Peerwise.